Welcome back to the channel, Future Financial Pros. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and what makes them tick. Our screeners have flagged a truly unique contender that's generating some serious buzz due to its extreme cost-to-borrow metrics. We're talking about CLRO Inc., ticker symbol CLRO. This isn't generic analysis, we're breaking down CLRO specifically, using real numbers to understand why it's appearing on our radar right now. Let's get straight into it. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo / stock chart. Let's zoom in on CLRO Inc., or CLRO. This company operates in the technology and communication equipment sector, though it currently has limited significant operations. Historically, CLRO was involved in designing, developing, and marketing professional audio conferencing, microphone, and video collaboration solutions. Incorporated in 1983 and headquartered in Salt Lake City, Utah, CLRO is currently a micro-cap stock with a market capitalization of just $20.06 million. Looking at recent price action, CLRO saw a plus 16.16% jump today. However, the last 5 days have seen a minus 20.31% decline, contrasting sharply with a remarkable plus 138.82% surge over the last 30 days. Today's volume clocked in at 2,606,100 shares, which is relatively light compared to its 30-day average volume of 6,422,523 shares, giving us a relative volume of 0.4x. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB? Geographic CTB definition in simple terms is the annualized fee that short sellers pay to borrow shares of a stock before selling them, hoping to buy them back later at a lower price. This fee is paid to the lender of the shares, usually a brokerage. Why does it matter? A high cost to borrow is a direct signal. It tells us there is either extremely high demand to short a stock, or the supply of shares available to borrow is incredibly scarce, or often both. When these fees start to skyrocket, sometimes exceeding well over 100% on an annualized basis, it indicates that holding a short position becomes incredibly expensive, day after day. Why this stock is hard to borrow right now? Show screener data graphic. Now, let's connect this to CLRO. This stock didn't just appear on our hard-to-borrow screener by chance. Its current cost to borrow fee is an astonishing 819.5% annualized. Yes, you heard that right, 819.5%. What's even more compelling is the CTB momentum, surged by plus 806 percentage points over the last 5 trading days. This isn't a static number, it's accelerating rapidly. Highlight 100 shares available. Even more critically, at this moment, there are only 100 shares of CLRO currently available to borrow across the major brokers. Couple that with an estimated float of just 0.7 million shares, and you have a recipe for extreme tightness in the borrow market. Our internal composite squeeze score, which combines factors like CTB level, CTB momentum, shrinking borrow supply, float size, and technical setup, rates CLRO at an impressive 82.6 out of 100. This confluence of factors makes CLRO a textbook example of a hard-to-borrow stock right now. Squeeze mechanics explained. Show animation, short squeeze process. So, what could happen with a stock like CLRO under these conditions? This is where the short squeeze mechanics come into play. A short squeeze occurs when a stock's price rises sharply, forcing short sellers who had bet against it to buy back shares to limit their losses. This short covering creates additional buying pressure, driving the price even higher, trapping more short sellers in a compounding feedback loop. With CLRO's cost to borrow at nearly 820% and only 100 shares available to borrow, any significant buying pressure could quickly overwhelm the limited supply. Short sellers holding positions would face immense pressure from both the rising share price and the exorbitant daily borrow fees, potentially forcing them to buy back their shares, further igniting the squeeze. Dilution risk check. Show graphic, dilution risk, none found. An essential check in any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, which can flood the market, increase the total share count, and often depress the stock price. This can completely negate a short squeeze thesis, even with high cost to borrow fees, because the increased supply of shares makes it easier for short sellers to cover their positions or for new short positions to be established. For CLRO, Our diligent checks found no recent dilutive SEC filings such as SMIN-S1, SMIN-S3s, or 424BS in the last 90 days. This means, for now, the company hasn't recently indicated plans to issue new shares, which is a positive sign for the squeeze thesis, removing a major potential headwind. We also found no recent reverse splits for CLRO in our look-back window, which can sometimes artificially inflate share prices and mislead. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. While CLRO's metrics are certainly intriguing, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have strong conviction and are willing to pay these high fees to maintain their bearish bets. So, what should you watch for with CLRO? Keep an eye on sustained buying volume. Today's 0.4x relative volume isn't exceptionally strong, but a consistent increase could be key. Further reductions in the already minuscule borrower supply of 100 shares would be significant. And, of course, monitor the cost to borrow. Continued escalation indicates intensifying pressure. Given CLRO's tiny estimated float of 0.7 million shares, any meaningful buying interest could translate into rapid and volatile price movements. Show CLRO chart with key metrics highlighted. Clear 1. CLRO is presenting a truly unique scenario in the market today, driven by an exceptional 819.5% cost to borrow, a critically low supply of just 100 borrowable shares, and a small 0.7 million share float. While the lack of recent dilution risk is a positive, the market remains unpredictable. It's a compelling case study of what happens when the borrower market tightens to an extreme degree. But remember, this is all about understanding the mechanics, not a call to action. If you found this deep dive into CLRO's hard to borrow status insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other hard to borrow stocks you want us to cover. We love hearing from you. Thanks for watching, and we'll see you in the next video.